Hey everyone, welcome back to Corporate Decoder. Today, TCW Steel City Senior Lending BDC just filed its first quarter 2026 10Q, and I am looking at some interesting debt and credit facility numbers. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is growing its debt investments fast, but its borrowing costs might be a growing concern. Let's dive into what they are investing in. As of the 31st of March 2026, this company is heavily invested in debt. They have over $380 million in debt investments across various industries like building products, capital markets, and food products. They are also holding over $380 million in short-term investments, which seems like a lot. But it is mainly government treasuries, so not super exciting but safe. They also have about $7 million in cash equivalents. So looking at their total investments, which are actually over $769 million, it is quite a large portfolio for a company like this. Interestingly, over $380 million are in debt investments. This means they are essentially lending money to other companies. The majority of these are term loans and revolvers, which are common types of business loans. Now let's look at their balance sheet. As of the 31st of March 2026, their total assets are over $819 million. This is a significant jump from the 31st of December 2025, when their assets were around $728 million. On the liabilities side, they have a term loan of over $100 million. This is backed by their credit facilities and reflects a more strategic use of borrowed money compared to their previous situation. They've also got over $88 million in revolving credit facilities payable, which is less than the $223 million from December 2025, showing they are managing their short-term borrowing effectively. Their total liabilities are around $575 million, down from $609 million at the end of 2025. This suggests they are managing their debt, though it is still a substantial amount. The number of common shares outstanding has more than doubled from around 6 million at the end of 2025 to over 12 million by March 2026. This indicates they have been actively issuing new shares, likely to fund their investments. And the net asset value per share has grown from about $19.74 at the end of 2025 to over $20 by March 2026, which is a positive sign. Looking at their income statement for the first quarter of 2026, they generated over $8.6 million in interest income. This is up from zero in the same period last year, which makes sense as they were just starting out then. However, their expenses are also significant. They spent over $3.2 million on interest and credit facility expenses. That is a big chunk of their income. They also paid out over $500,000 in incentive fees and another $375,000 in management fees. So after all expenses, their net investment income for the quarter was around $3.8 million. Not bad, but those interest costs are definitely a major factor. They also saw over $1.4 million in unrealized appreciation on their investments. This means their investments have grown in value on paper. Overall, their net increase in assets from operations was a healthy $5.2 million for the quarter, showing good growth. Their total net assets or members' capital reached over $244 million by March 2026, up from about $118 million at the end of 2025. This shows substantial growth in the company's value, largely driven by new share issuances. On the cash flow statement, their operating activities used nearly $80 million. This is because they were actively buying investments and managing their short-term positions. But they brought in over $83 million from financing activities, mainly through issuing new shares and managing their credit facilities. This shows they are actively using debt and equity to fund their operations. Let's look at those credit facilities more closely. As of the 31st of March 2026, the company has access to over $475 million under its asset-based credit facility and another $200 million under its subscription-based credit facility. While they have significant borrowing capacity, they are using it. They have over $105 million drawn on the asset-based facility and over $88 million on the subscription-based one. This means they have access to over $187 million in borrowings outstanding. This level of debt financing is a double-edged sword. It can amplify returns when investments perform well, but it also magnifies losses if things go south. And the cost of this borrowing is notable. The weighted average interest rate on their credit facilities was over 6%. With interest rates rising, this could put a strain on their profitability. Now, they also have significant unfunded commitments, meaning they have promised to lend more money in the future. As of the 31st of March 2026, these unfunded commitments total over $84 million across various investments. This means they will need to find more capital or deploy more of their credit lines to fulfill these promises. The company is sensitive to interest rate changes. Since most of their investments are floating rate, a rise in interest rates could increase their investment income. However, their borrowing costs would also increase. They've provided a sensitivity analysis showing that a 1% increase in interest rates could boost net investment income by about $1.9 million. But a 3% increase could add over $5.8 million to their interest expenses, potentially squeezing profits. Finally, in terms of management and controls, the company states that their disclosure controls and procedures are effective. This is a standard statement, but it is good to see them affirming that their reporting is sound. Now, looking at the big picture, TCW Steel City Senior Lending BDC is in a rapid growth phase. They are actively lending money in the alternative investment space, which can offer attractive returns. However, their reliance on debt financing and the associated interest costs are a significant factor to watch. The substantial increase in share count also means more dilution for existing shareholders, but it is funding their investment growth. The risk I am watching is their interest rate sensitivity. If rates continue to climb, their borrowing costs could outpace their investment income, putting pressure on their net profits. What I am actually looking for is how well they manage this leverage as their portfolio expands. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe, and join our Discord linked below.